Dare I say it, guys, Apple saved the stock market. And we're going to talk about exactly why Apple is saving the stock market here today. But you also have PCE data that came out today, which PCE, if you guys are unaware, is the preferred measure of inflation to the Fed, to big boy Papa Powell. That's what they like to look at. And that was a little bit better than expectations. So we're going to talk about that and how this rally really could have some leg to it, because on a technical basis, we just broke out above a major resistance level on the S&P 500. Usually, if you break out to this degree above a major resistance level, usually good things are to come from that. So we're going to dive into this whole situation, guys. Look at the technicals for the S&P, for AMC, for really everything you guys need to know. We're going to look at the Ortex data behind these two companies and economic events that will be starting here next week that really could give us that continued rally. So let's get into it, guys. The only thing that I ask is that you hit that like button and subscribe to the channel, because it is free $99 and it helps push this information out to as many people as possible that could use this information, things that you will not hear traditional financial media even talking about. So let's get straight into it, guys. S&P 500 up about 2%. Apple stock is up like 9% today, specifically up 8.35%. So Apple is definitely affecting the markets in a very bullish way. And it's not just that Apple be on the top and bottom lines, which that's obviously going to be a positive thing, but Apple started to be a little bit more realistic with the markets. Apple said that the current holiday quarter does not look as good, or the start of it, right? The first 8 days, we're 9 days into the holiday quarter now, into Q4. They said this quarter doesn't look as strong as last quarter. So it really lowered expectations. And it's one of those things where if, you know, the Fed came out initially and they never used the soft landing verbiage. If they said, yeah, guys, we're probably going to go into a recession because we printed too much money and we're going to have to raise rates to 4 to 5% by the end of the year, the markets were only expecting 325 basis point rate hikes. If the Fed would have said that, we would have bottomed a long time ago and we would be on the road back to recovery. Maybe it would have been a sharper drop, whatever the case is. The markets like when important people and important companies are real with them. The markets can spot bullshit from a mile away, kind of like the Fed Jerome Powell, Papa Powell, saying inflation was transitory for 3, 4, 5 months, and the markets never once believed him, right? Kind of my example here. So there is that, and that's a big thing. But the PCE might be a little bit more important. You guys can see this initial reaction from PCE was a very positive one, with this 1 minute candle giving us a gain of about 0.62% on the S&P 500, which is a pretty damn big move if I do say so myself. And it does say the key inflation gauge for the Fed rose 0.5% in September, in line with expectations. It says the core personal consumption expenditures price index in September increased 0.5% from the previous month and 5.1% from a year ago. Including food and energy, PCE inflation rose 0.3% for the month and 6.2% on a yearly basis. Personal spending rose 0.6%, more than expected amid the rise in prices. So that, I would say, is a positive thing. Now, here is what really made the markets go up initially off of the PCE report. This says the core personal consumption expenditures price index increased 0.5% from the previous month and accelerated 5.1% over the past 12 months, the report showed. The monthly gain was in line with Dow Jones estimates, while the annual increase was slightly below the 5.2% forecast. So simply put here, the forecast, the expectation was for a 5.2% yearly gain, and we only had a 5.1% yearly gain. And that's the thing, guys. This could have came in much higher, but it was lower than expectations. And that's where you're going to get these very violent bullish reactions if you get economic data that's important to the markets like PCE that comes in even slightly better than expectations. And why this is so important is because the bond market is really trying to figure out what the Fed is going to do right now, because we have the next Fed meeting November 2nd. That is next Wednesday, and about 85% of market participants expect the Fed to raise rates by 75 basis points, which they likely will. If they go 50 basis points, that's going to be very, very bullish for the markets, because only 14.8% of market participants expect that 50 basis point rate hike. So we're much more likely to get a 75 basis point rate hike. But hey, who knows? The Bank of Canada was expecting to give a 75 basis point rate hike, but they only went with a 50 basis point rate hike. Maybe that's a precursor to what could happen with our central bank. We'll have to wait and see on that. But the real question is for December, because guys, the markets are split on December. 48% of market participants are expecting a 50 basis point rate hike in December. This is the highest probability that we have seen for a 50 basis point rate hike in really a very long time now. And that's partly why the markets are also rallying today. But there's still a 45% chance of a 75 basis point rate hike. So really nothing is set in stone for December, and the markets are looking for any clue or hint of anything that will get the Fed to slow down to try to anticipate that. But as of right now, depending on what the Fed says next week, that's going to be the main dagger in the coffin for the markets per se. If the Fed says, yeah, guys, we're way off our 2% target, we got to keep raising rates 75 basis points, well, that's going to upset the markets. Not going to be a good thing whatsoever. If the Fed says, yeah, guys, we're going to slow down, do this 50 basis point rate hike, and then evaluate from there, well, welcome to the next bull rally. I can't say that would be the bottom for the markets, but I would say that you could probably expect another 10 to 15% rise in the S&P from these levels. It would still put you down 10% on the year, 15% on the year, in between that range. I don't have the actual number right in front of me. You'd still be down a lot even if the markets rallied 10 to 15%, guys. So that's really the key, and that's a big reason why the markets are also rallying today, is because the probability of a 50 basis point rate hike over a 75 basis point rate hike in December did go up today based off of the good PCE numbers. So that is mostly it for why the markets are rallying today. TLT is going back down today, which is bad. That means bond yields are indeed rising yet again. We've seen a little bounce in bond yields, meaning bond yields have went down just a little bit over the past couple of days, and that has helped to fuel some of this upside move that we have been seeing, but you're starting to give it back here today. And as far as the dollar is back up yet again today. So even though we're having a very strong day in the markets, in equity markets, you're seeing the dollar is not playing along with this rally, and the bond market is not playing along with this rally. So the bond market and the dollar are trying to call the stock market's bluff. Usually they are right, but it all is going to depend on Fed Jerome Powell. Now, let's talk about the S&P 500 and this critical level we just broke out above, this major resistance level. And that is right here at the 50-day moving average, sitting at 382.69. Now, it is possible we close under the 50-day moving average by the end of the day, but we only have about two hours left of the trading day, so I think that is very, very unlikely that we will at this point. And we are also right under our 200-day moving average. And this might be the range that we trade in heading into the Fed, in between the 50 and 100-day moving average. And then from there, we might make that final move. But typically, when you break out above a major moving average, such as the 50, 100, or 200-day moving average, with a big gap up above that level, typically you tend to hold those gains longer than not. Now, with that being said, guys, let's take a look at AMC for a brief second, just so I can show you guys what I mean with the 50, 100, 200-day moving averages. And you can see, like right here, you broke out above the 50-day moving average with a clean candle, a clean gap up, and you continue to rally from what was this, $7.60 on the low to $11.29 per share. That was almost a 100% increase after you broke out above that 50-day moving average. Same thing back here, but you remained above the 50-day moving average, the resistance level. And you actually had resistance right here at this yellow line, or this orange line, I should say, at the 100-day moving average. You broke out above that, and you went up over 100%. So typically speaking, breaking out above these moving averages is a very, very bullish thing. Now, if we take a look at AMC and where we're currently sitting, we are slowly trending back to the upside, but we're decently far off of our 50-day moving average, the important moving average first for us, and that is at $7.95 per share. We're currently at $6.63 per share, but the MACD is looking good, and the RSI does signal to me potentially we do have more of an upside move to go from here, because you're still under 50. You're still under the neutral level. So technically speaking, AMC stock is still oversold on that basis, and the volume has been pretty low, and I think that's really due to a lot of hedge funds are continuing to short the stock until there's really a reason not to, until, you know, the Fed does potentially pivot next week and give us a smaller rate hike or indicate they're going to. That's when you could potentially see a lot of shorts get squeezed out of their positions in AMC as well as the broad markets in a very aggressive manner, and that's kind of what I'm looking forward to if we do see that Fed pivot. But as far as earnings season, it doesn't look like earnings season is going to be the thing that takes down the stock market as of right now. It really all hinged on Apple earnings, and Apple did do good enough for the markets this time around. Now, let's go ahead and what is this? One second, guys. See, we have 2 buy targets updated 5 days ago. Yeah, they just lowered their price. That's not surprising. It said there was a price target change on AMC over the past 5 days, and obviously they revised it down to the downside. Nothing new there. But as far as AMC on the day, the estimated short interest of free float is sitting still at about 20%. The free float out on loan at 34.64%. This has come down just a little bit, and the shares out on loan is sitting at 178.5 million shares. Days to cover at 4.74, cost to borrow at 18.86%, and 100% share utilization. If we look at the live short interest, you're looking at about 101.24 million shares that are sold short, which is very high and much higher than where we were even last week. The demand for AMC shares to sell short is very, very high. The cost to borrow max sitting at 20.14%, cost to borrow minimum at 0.35%. That is not true. That's almost laughable at this point. Cost to borrow average sitting at 14.66%. And as you guys can see right here, the shares that are actually available to be sold short, around 500,000. The cost to borrow rate on that is about 18%. So more in line with the cost to borrow max, and definitely closer to the higher end range. So there is all of that. As far as the option activity for the day, you're looking at 3 orders totaling about $95,000 with a positive order value of 100%. You're seeing a November 18th 750 call, a November 4th 750 call, and a November 4th 750 call as well, worth about $70,000 for the 750 calls for November 4th, and about $15,000 for the November 18th options trade, and that is betting that AMC goes over $8 by November 18th. The November 4th trade is betting AMC stock at least goes to $7.70 per share, increasing about $1.10 between now and next week, which would be a rally of roughly 20% on AMC stock. So someone is actively betting that AMC is going to go up at least 20% by this upcoming Friday. So there is all of that, and that's mostly what I wanted to talk to you guys about here in this video. Some technicals on the S&P 500 as well. You're looking at about 58.76 on the RSI. Neutral is 50, so you're a little bit above that neutral level, but you're still not really overbought in a big way, right? You're not close to 70 like we were back here in August. That's really what I could expect to happen if you do get this Fed pivot. It's going to be a large sustained rally and potentially even going higher than 430 on the S&P 500. That is very, very possible as well. Now, the MACD is sitting at the lower end range, but you are seeing this gap between the blue and yellow line widen, so that is looking much more bullish than not as of right now. Currently speaking, S&P 500 up about 2%. AMC stock, let's go ahead and give it a gander, is up about 2% as well. So in line with what the markets are doing. So guys, thank you for watching. That is going to be it. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, also link down below in the description of this video. You guys enjoy the rest of your day. I will see you guys at 4, or if not, bless you guys. I'll see you in the next one.